really changed the dynamics of restructuring. Internal restructurings, we have seen a lot, especially with economic downturn. When people were facing the heat from the economic front, there was a lot of financial engineering or restructuring. And what about succession planning issue then on this?
Okay, so inheritance tax was a fear. Inheritance tax has not happened.
Yes.
But clearly it will happen sometime.
Okay.
Because the way the laws are moving, they're getting internationalized. What is happening is GAR comes in April 1, 2017 onwards. So whatever restructuring one has to do, one has to finish before April 1, 2017, otherwise get caught in GAR. Now there are 3-4 provisions which have happened which will disenable internal restructuring. The first one is, see, like suppose if I sell shares to you, if I sell unlisted stock to you, today I can do it at whatever price.
Yes.
If I sell a 100 rupee share to you for 10 rupees, you have to pay tax on 90 because it's a deemed gift in your hand of 90. There's a law which says now, for my perspective also, I have to pay tax on 100. Even though I get only 10 rupees from you, there's a deeming section introduced that unlisted transfers will be taxed at fair market value in both our hands. So double taxation. So all these internal reorganization, okay, transfer shares at par, transfer shares at this price will stop. That's one change which has happened. Second is last year, I remember going on some of your CNBC forums wherein people said that, okay, now this 10% additional tax on dividend has come, let's put everything in a trust. So everybody rushed and formed trust, transferred their shares, hoping that if they form trust, that 10% additional taxation rate will not be applicable. They've clamped that. They've said, irrespective whether individuals own it or trust owns it, 10% tax is payable. So that's another dampener on succession planning, which one has to be careful about. So there are things in this budget. And the third change is that previously the deemed gift sections was applicable only for private companies. So if one private company got shares of another private company, deemed gift was applicable. If it got shares of another listed company, immovable property, deemed gift was not applicable. That section also has changed. So if you were doing internal reorganization, transferring businesses, transferring properties, listed company stocks, previously there was no issue, now that's also got clamped. So if you put cumulatively all these sections and GAR coming in, there is a big case in the next 2 months for people to clean up whatever they want to clean up, whatever right structure they want to come up with, so that they are ready to face the new GAR world.
People want to do the structures, like Girish mentioned, want it as simple as possible, because if the trust has to deal with listed stock, the implementation is an issue. It's not just about tax. It's also about voting rights, how they will be exercised. And there may be big families and multiple brothers and sisters, and how do you implement that? That becomes complicated. So this estate planning was more not only from a financial tax, but also for the future. That how do you want to distribute the assets between the children and to secure that. I think so. While they'll have to address the tax issue, they will also need to tackle the legal issues. If they make it too complex, the implementation may become an issue in future. Because stakes are held in multiple listed companies. You decide that one son will handle one business, the other one will handle the other business. How do you implement? Because at the end of the day, the rights are exercised at the board meeting or at the shareholders meeting. And how does that get implemented? So the more complex the structure, the more difficult from a legal perspective to implement it in real terms.
But India enjoys the chaos and complexity.
I think we love problems.
We love that. Now, also wanted to understand the thin capitalization rules. Is that going to really hit real estate as well as infrastructure?
All deals, big deals globally, have a debt element to it. Then only IRR goes up. People push down debt. So let's say if you look at sovereign wealth fund, if you look at the real estate portfolio acquisition, infra portfolio acquisitions, or even look at bigger size deals in the Indian context, people push down debt. When the debt push down happens, interest is charged. And it's a related party debt because you own 100% of the company and you finance the acquisition through a debt. When interest is charged today, any quantum of interest is tax deductible. That has two advantages. The Indian company gets a tax break on interest, and second is the money gets freely repatriable. There's only a 5% withholding on interest, the extension of 2010. So two big advantages which drive IRRs.
Yes.
Tax deductibility in the Indian company and a 5% withholding for sending the money out.
Yes.
Repatriation is also very easy. They are going to clamp this. They are saying that now tax deductibility will be only 30% of EBITDA. And balance will be carried forward for 8 years. So all IRRs will go for a toss. Deals are getting bigger and bigger. A fund acquires $2 billion of real estate portfolio.
Yes.
A fund acquires...
We always see leveraged deals.
Exactly.
It's only when you have a strategic investor, because he looks at a long-term vision in India. I mean, he wants to be in India for the next 20 years, 50 years, 100 years. He wants equity. But whoever wants to exit, whether it's 5 years or 10 years, would prefer an instrument. For two reasons.
Fixed return or some capping.
Some surety.
Some surety, and therefore the Tata Docomos and the Bajaj
Exactly.
Allianz
What is it? It's all the same.
GMR, SBI, Macquarie, all these are...
And also gives them an edge to take out some money during the investment period. Because whether it's an interest coupon or on preference shares, there is dividend.
So this thin capitalization rule that has really come in, is that going to have an impact on REITs and InvITs as well, which is just about taking off?
Of course, if they...
Because the inception of REITs and InvITs has been some investor coming, then rolling it out.
Yes. And you know what my worry is?
Yes.
Forget the deals going forward. The deals which have already happened on a IRR assumption of deductibility will also be in problem. So you go back to your drawing board and work out your revised IRR.
So a large transaction like Bharti Infratel, which would be probably leveraged, debt-laden.
I'm not close to any transactions in particular, but clearly it is because EBITDA test is every year now on. It doesn't say any deal done after April 1, 2017 will have this. It talks about all interest deductibility or deals of the past also. So I would say this is certainly...
Deals of the past also?
Deals of the past where interest is going to be claimed next year.
Okay. That's a very interesting point because it just changes the entire dynamic. It's not only about you looking at it and then making a deal, but you've already gotten into it.